All right. Hello and welcome to Wealthologist, March 2024. It is officially spring, Jacob.
Yep.
A new quarter is just about here. And, hey, we hope everybody out there is feeling good and having a good start to 2024. I will tell you, my exciting start to 2024. Some of you may know I love fish. I like to go fishing, but my real passion is actually koi fish. I love koi fish or just fish in general. So recently we just finished building a little hobby pond at the house. And this weekend I put fish in my hobby pond.
Oh, nice.
And I got to tell you, this is like spring is here. Now, here's the problem. The truth be told, I started out with small fish because you start out with small fish to make sure that they're surviving in the water.
Right.
But they keep going into the kind of the drainage, and I have to keep saving them. So every morning I'm waking up and saving fish. So it's quite exciting. Anyhow, that's my spring.
There you go.
I know spring for you guys. I know the little guys are a little sick right now.
Yeah, yeah, battling the snotty nose, but it's okay.
And Jacob, I didn't even introduce you, but everyone, you already know Jacob. Jacob Woodrum, who is our lead investment strategist and partner to the Wealthologist here. Jacob, it's been a pretty strong start to the year.
Yeah.
We've had a couple of bumps here and there, but nothing crazy. But some things have shifted, and some kind of some of the thoughts around what's going on in the market and some decisions that are going to be made in the market, I think, are changing as well, specifically with presidential elections.
Yep.
So today, what we're going to talk about is, we're going to touch on inflation because inflation continues to be one of those things that's just like out there bugging us. And also how that's driving the Fed's decision-making process and whether or not and we've talked about this for forever, whether or not they're going to be messing with the rates. And if so, when is the thought that they're going to be changing rates and what that looks like. So we'll dig into that in just a couple of minutes. And then we're also going to be talking a little bit about specifically what's happening internally at our office with portfolios. How are we adjusting and tweaking portfolios right now, given really everything that's going on, to make sure that we're looking for the right opportunity right now. Yeah. So Jacob, we're going to start with the Fed.
Yeah.
But before we go into the concept of what's happening with them, we had a question from somebody recently, and they said, boy, you and Jacob talk about the Fed all the time. And on the news, they talk about the Fed. But the question was, I don't really understand what the Fed does, what the Fed is. And so real quick, 30 seconds. What is the Fed?
Yeah, a great question. It is one that we talk about all the time, and I think I make the assumption that, everybody knows what the Fed is. But at the end of the day, the way I think about the Fed, it is our central bank. So it's the United States Central Bank. It's made up of 7 or 8 board of governors who sit, on a committee. And really, for lack of a better term, they control the money supply. They decide, where interest rates need to be set based on supply and demand and a lot of other factors. But that's really the way I like to think about the Fed.
Okay. And just to be clear, the Fed is not a political arm.
On the surface, it's not.
Yeah, okay. And you guys can debate that at home on your by yourselves.
Yep.
But on the surface, the Fed is supposed to
be separate,
apolitical, without political influence. But we can always argue that all politicians try and get the Fed to do things in their favor to get the economy in the right direction. All right. So what's the Fed doing?
Yeah. So what's wild is they're actually meeting today. So the timing of our discussion was pretty good.
In less than an hour.
Yeah.
We could basically be the Fed.
Right.
Chris and Jacob are the new Fed. Welcome. All right. Maybe
no,
not.
Thanks.
Yeah. Right.
No, but they're going to be meeting today at 2:00, and they're, like we said, going to determine interest rate policy for what we're expecting moving forward. And I think it's pretty likely we see the Fed pause. So I don't think they're going to raise rates. I don't think they're going to cut rates at this meeting. A couple reasons why. We experienced what I would call kind of a slight delay in disinflation. And that just means, that's a big word, right? It's the words we like to use, or I like to use, and Chris calls me out when I use them. But really what disinflation means, it's just a decline in the rate of inflation. So really, in other words, what we're saying is inflation's been a little bit stronger lately than we would like, and what the Fed would like. And in our opinion, I think the lagged effects of some of this strong wage growth that we saw in 2023, that's probably likely to fade a little bit in the coming months. So because of that, I think Fed members, they've expressed some concern that the risk of reflation, or just inflation getting stickier and not going away, could be more of a concern than weaker growth in the economy. And that's caused by typically by overly restrictive rates. Now, I know we've got a slide up here that we want to take a look at as well. And I think this slide just does a really good job of showing us from a data standpoint, what typically occurs if we do get a rate cut. And, to the point that Chris made earlier, we're always talking about the Fed and what they're going to do. And, you guys may sit there and be like, well, why do they always talk about the Fed so much? But you can see based on this slide that, a Fed rate cut, if it doesn't result in a recession in the economy, it's historically been really good for the stock market. And if we look particularly at the right-hand part of the slide, we can see that, over a 1-year average, U.S. stocks have done very well with a first rate cut and not having a recession. Even the bond market, being up 8% on average is really good. I think the one thing that stood out to me was, you see on the down negative 5.6%. Well, that's if we get a first Fed rate cut, but we do get a recession too. We see, okay, well, stocks could come down, which is not a surprise. But I think what's interesting is you see the bond, the 1-year bond return still pretty attractive and almost about the same as if, compared to the 8% of a first Fed rate cut and no recession. So pretty interesting.
Now, do you think, obviously, when we talk about the bond piece of that, is as bond rates drop, obviously the new bond issues, their interest rates are not as favorable, but existing bonds kind of increase in value, and that's kind of what we see happening in that type of scenario.
Exactly. Yeah, that's the main reason for the driver of seeing those returns still being pretty attractive. And we've got another slide I think in a little bit to talk about.
Okay, yeah,
too.
that's right. I'm jumping ahead. You know me. So I think the big question that's probably on everybody's mind is with this information that we have now, which is again some newer information in 2024, the first quarter. How is this expected to impact the Fed policy?
Yeah, it's a great question, and I mean it could go, it could obviously go a couple of different ways, but we were, thinking in our base case here at the firm, we talked about it a lot, is that we expect rate cuts in June. I think June, middle of the year, at a minimum, I think is probably the highest probability, and why it's our base case scenario.
So just as an aside, if you're in North Carolina, recently we just got DraftKings and the right to bet. And I feel like all the advertisements everywhere are about betting. And this seems like something that somewhere somebody's probably got bets on this, because I feel like over the past year we have talked, there was talk that, 6 rate cuts in 2024, and then maybe 3, and boy, it was going to be really early in the year, and now we're looking all the way out to June. I think what's important to think about with this is the Fed is making decisions on real time.
Incoming data.
Exactly. And again, that inflation number that you talked about before was really a big driver. They were kind of hoping inflation was going to be tampered down quite a bit more, and it just wasn't.
Yeah. And so, I think if we do get these rate cuts, in our minds, it's like, okay, well, what does that mean for the markets? And from a fundamental standpoint, decreasing rates should be good for market performance. And we're going to take a look at this slide here, which I think does a good job of kind of illustrating that dynamic, and especially from a bond perspective. If we think about it, we've used this analogy a lot, but if you've got a seesaw at the playground and you've got on one hand interest rates and the other hand the price of bonds, they're inversely correlated. So when one goes up, the other one goes down. And this slide does a good job of showing us what the price and the total return of the bonds do, of a core bond portfolio does, in a decreasing rate environment, but also in an increasing rate environment. And, we won't spend a ton of time on the slide, but you can just see, on the left-hand side, core bond total return of 12.3%, which that's just the average return of the income aspect, but also of the price movement if we have rates going down, which is quite frankly very attractive from a bond perspective, because bonds aren't, historically are not as aggressive as a stock investment. But again, even on the right-hand side, we can see the dynamic at play if yields were to go up. Now, we don't feel that we're in an environment where we're going to see rates going up at this point, so we would pay more attention to the left-hand side of this slide, at least at this point.
And I think when I think about seeing that we're thinking that rates are going to come down, and we're going to talk a little bit about this, that does impact portfolio, what drives a portfolio.
Right.
The potential to see some more fixed investments inside of there, because that's, rates go down, we're going to see that reward is built in there. So it should be something that we kind of look towards in the portfolio.
Right.
Now, since this is an election year, how do we think that that's going to be playing into the markets really over the next couple of months? I mean, I got to tell you, now that the 2 players are picked, it just seems like it's going to heat up. And again, it's that old saying that it's different this time, and we've heard that before, and it feels different, but it always feels different.
Right.
So we've always had political turmoil and craziness, but what can we learn from the past that has happened, and how that applies, and what we kind of expect going forward right now?
Yeah, and that's really a good point. What you made is just looking at the past, because we typically, you want to look at historical performance and data and different points in time, and how were those similar and different than what we're experiencing now. I think a lot of people go into, and we talked about this a little bit last month, a lot of people go into the election year thinking it's just going to be horrific. It's going to be tough. It's going to be, from a media standpoint, it's always challenging, right? But even from a market standpoint, but I think it's going to be different, or could be a lot different than most people expect. I mean, typically, And we've talked a little bit about this, but typically the year of a presidential election, it tends to be historically the second best year on average. In the S&P, right around an 11% return, which is I think surprising to some people when they hear that data. Now, obviously, it's averages and things can be different.
Averages
but I think
lie.
that's important to make a mention of. But divided market tends to be, or I should say, divided government tends to be good. For the markets overall, and we've got some really interesting data that I think if anybody ever wanted to dig into that more, we could always share that with folks.
Yeah,
too,
I actually think that we're going to be coming out with more of a totally rounded presentation around the market, and we'll probably either do it through one of the Wealthologist lives like this, or through a webinar coming up. But we've got some great data that talks a little bit about that, so people can kind of know what to look like, and you can talk to your friends and just really look smart, because when they're saying one thing, you say, actually, the numbers tell us this, and then you can thank us for that, because who doesn't like to look like the smartest person at a party?
Well, and so just to answer Chris's question, to get back to Chris's question, I think from a market standpoint with the election this year, historically, we tend to witness some weakness and consolidation, meaning not a lot of growth typically in the first half of the year, in the year of a presidential election. Then a lot of times we do see a rally once we get into, the election uncertainty is kind of past at this point. We're in the second half of the year. This year we've talked about, I think, given some of the political discourse that we will probably experience, and the possibility of potentially a close race, that uncertainty, I think, could cause the market potentially to remain a little bit choppier, longer than usual. But we'll see how it pans out.
Yeah, and we talked about that at our last live event, and that was last month. If you you should have gotten a recording of that in your email, probably in the past week or two. It's also on our YouTube channel, The Wealthologist, so you can always go there to check that out. But during that live event, we talked about some of the opportunities that we're seeing based upon the current economic environment. And I think that's what a lot of people, obviously, that's what people are looking to us, specifically, Jacob, with your insight. As a CFA, your job is to say, where is the opportunity in this? And I guess, has anything changed since we last talked? And then how are we looking at positioning inside of portfolios where the opportunity might lie for our clients?
Yeah, it's a great question. And actually, it's interesting. We've, even within the last week or two, we will be making some shifts in our portfolios. You guys will probably see some of those trade notifications coming through to your inbox. That does make some of those proactive changes in light of what we're seeing. And a couple of the highlights, and I'm going to touch on this in just a second, which quality continues to be our main theme. But we've recognized that the tech stocks and the AI trend, we talk a lot about that, and it's probably an over talked about theme just in mainstream media and things, but it is a structural trend that we view as over time sustainable. So we've made some adjustments within our portfolios just to tactically tighten up and shift and adjust some of the allocations to more of what we consider more growth focused investments. But as I talked about earlier, our theme really continues to focus overall on quality, and just we talk about better, which is what we are expecting this year. We're probably going to slow down a little bit more so than we did from last year. I do have a little bit of data on, or just some data points to talk about from a quality perspective. It does tend to outperform following Fed holds, which is where we're at right now. The Fed is holding on interest rates versus all stocks, but it also has done really well when the Fed also pivots to cuts. And the reason we like it is it allows us to, for lack of better terms, put in some downside protection with risk controls, but it still allows us to participate in the market movement of the S&P 500. So we know there's no free lunch in life. And so if we're getting some downside protection, we're not going to get all the upside of the market, but it's a really unique strategy that allows us to complement some of the other strategies that we're using within our suite of different portfolios that we can build and use for folks. We do have one other slide that I wanted to just also mention here. I think this is, when I think about how a diversified portfolio over time really makes sense, this just really drives home that point. Now, this is comparing, a standard kind of 60-40 portfolio versus cash. So we're looking at this versus cash. But again, when we talk about using different approaches within our strategies for our portfolios, that diversified approach is just really, really important. And, we're in an environment where I don't know what the number is right at the moment, but I think the last time I looked last week, the number of the amount of money in money market and cash positions was about $6 trillion. And this slide just talks about how, likely outperformance is for cash versus a diversified portfolio. We can see that it's really low over time. So again, just kind of drives home the point of the importance of a diversified strategy with different strategies doing different things. So as I kind of wrap up our time here with my section, I did want to talk a little bit just in terms of strategies, and it's not about timing, but it's more about building a portfolio that's a diversified portfolio. So Warren Buffett, we all know Warren Buffett, he's got a great quote, and he talks about how predicting rain doesn't count, but it's building the ark that does. And I love that quote because it really just drives home the point for me, and hopefully for all of our clients as well, that we know it's going to storm, we know the rain comes at times, but rather than try to predict that, let's just make sure we're building a proactive, fundamentally sound investment approach, and that really tends to win out over time.
That's great, Jacob. I think that's important for us to take a look at, have people understand what's going on in the economy, but then how does it apply, right? and how are we putting that in play? Yeah. So I really appreciate your input on that. I know you've been putting in a lot of overtime work as things have been changing, but now we get to shift to a segment that I always like. It's called Hey Hobart. And this is where we take questions from all of you out there in the world, and we answer them right here. Now, the way we do this now, until our compliance allows us to do it differently, is you have to send your question to us. So if you've got a question and you'd like it answered by us, you can send it to heyhobart@hobartwealth.com. And hey, if you're lucky enough, we might just feature it in one of these events. So today's question: I'm in the process of setting up a revocable trust. What assets can I or should I not put into a trust? I think that's a good question because sometimes people think, you just throw everything in there. Right. Now, quick note, Jacob, you and I, nobody on our team, we are not estate planning attorneys. So we do work closely with estate planning attorneys. And when our clients are setting up trusts, we work with those attorneys to make sure that assets are titled correctly and everything works the way that it should. Now, you may have heard the term either a revocable trust or a living trust, same interchangeable in that. The thing with these and why people like these, it lets you manage and use your assets while you're still alive and then pass them on to heirs without going through probate, as well as adding maybe some rules if you want to that money. The key is there are some assets that should be left outside of the trust because of tax or registration issues. So, for example, things like retirement accounts, a 401k or an IRA or Roth IRA, those should be left outside of the trust. And that's because the trust is registered as a separate entity. And if you move the funds to a new entity, that is a taxable withdrawal. Don't want to create a big taxable withdrawal on your 401k or IRA money. That could be crippling. The IRS, any withdrawals are taxed as ordinary income, so that could be huge. Now, other types of accounts that generally need to stay outside of a trust, that's like a health savings account, as well as life insurance policies, unless structured in a very specific way, which is what we call an irrevocable life insurance trust or an ILIT. And again, in the insurance world, it can get very complex and very unique, but in general, you keep those outside of a trust for general planning. Plus, if you own a minor's account, so, I've got 2 kids. We don't have these types of accounts, but if we had these types of accounts, generally known as UTMAs or UGMAs, the ownership should stay outside of the trust as well. Uh, the better thing to do for these types of assets, especially like retirement accounts and life insurance policies, it's to name the trust as the beneficiary. Therefore, you still have, the beneficiary drives where the money goes, but the trust can still have rules for distribution. That way, again, the proceeds are paid to the trust and the funds are divvied up among your heirs according to how those documents are laid out in the trust. Now, if you've been thinking about setting up a trust, a living trust, or maybe you need to make sure that yours is current because those can go out of date as families change, as lifestyles change. Typically, every 5 years, you might want to have a review. Feel free to give us a call. We're always happy to point you in the right direction of an estate planning attorney or review what you have to make sure that everything is up to date. So happy to do that in any way that we can to help facilitate that process. Now, today you might have some additional questions about the topics that we've been talking about, or you might want to talk about something a bit more specific to your financial situation. Always know that we're here to help. You might sit there and say, man, inside my portfolio, I've really got a question. I think Jacob can have some good insight. Jacob's here for you. You might have some questions about koi fish. I'm here for you. Or if you've got questions about financial planning, tax planning, that's what the whole team's here. Andrew, Corey, Nick, Bob, all here for you, and our support staff as well. You can call or email us at any time with your questions about retirement income, investing, taxes, anything related to your money. That's why the team at Hobart is here, and that's really what we enjoy doing. So for today, that's really it for Wealthologist. March of 2024. We wish you a great start to spring, and we look forward to seeing you next month where we're going to be digging into some more great information. Until next time, we'll see you soon.